Hey guys, hope you're well. It's Alessio speaking today from Heathrow Airport in London. I just came here today to drop off my parents so they can get on the airplane. Now, as I was waiting here in the car park here in Heathrow, I came across an interesting article which I want to share with you. And this is actually quite hilarious and quite shocking because it seems to me a lot of folks in Wall Street are essentially misinforming people about what's really going on with the economy and the stock market. So let me share that with you in today's video. Now, you might remember a few months ago, I think it was April, that there was an interesting and very shockingly ridiculous article in Barron's magazine. This is Barron's Financial Journal, and which is one of the biggest journals in the world. And they published an article, which I shared with you, which was, and the headline was this bull market has no expiration date. I'm not kidding, guys. That was the article. This bull market has no expiration date. And by the way, when I read that article in Barron's magazine, my response was pretty much like this.
Hilarious. Hilarious.
I mean, that was such a ridiculous article. And I warned you at the time that whenever you see articles like that, extremely bullish on the stock market, pretty soon you're going to see a turning point, some inflection point or a drop in the market, which indeed it did happen. Just a few weeks afterwards in May, the stock market dropped quite massively and nastily, as we saw. In fact, the stock market's dropped twice since they wrote that article. Now, the thing is, when the stock market's dropped, the same folks, the same journals, the same financial writers, they were saying, oh, there's no expiration date on the market. They were now getting on the bandwagon saying, oh, the markets are collapsing. Oh, the markets are falling. I can't do the sarcastic voice, but it goes something like this.
The market. Yes, the market.
Now, here's the thing. You probably heard the recent news that the Federal Reserve has cut interest rates once again. And this is quite interesting because it seems that a lot of the financial writers, the financial commentators, are getting the wrong end of the stick when it comes to this decision. And it occurred to me as I was reading this most recent article in MarketWatch. Let me just share this with you, and it's quite interesting. So there's an interesting article in MarketWatch that was published just recently, and the headline is 3 things not to do with your savings now that the Fed has cut interest rates. Now, it gives some interesting information here. Not all of it is bad. But when I went to the end of the article, like the final paragraph, it says something which actually was quite hilarious. And I don't know if it was hilarious, but it was definitely interesting. So what they say is this. They say is don't make major adjustments to your long-term savings plan. That's okay. And then it says in the final paragraph, this isn't the time to pull money out of the market or make significant changes to your retirement planning. Instead, experts suggest seeking out healthy distractions like hanging out with friends or hitting up the gym. Wow. I don't know what to say about that, guys. Now, listen, is he partly correct? Yes. I mean, certainly you should not be making rash decisions. Nobody should make rash, uninformed decisions when it comes to their savings or indeed their investments. They should think things through and make an informed decision based on the research and the facts. So that's correct. But the part I object to are 2 things. Number 1, you might as well just say, hey, don't worry about it. You'll go and booze up and really don't worry about what's going on in the markets. Actually, what they should have done is, look, you should inform yourself better. You should take a bigger interest in what's happening in the financial markets. Now, whether that's reading some books about the financial markets or stock markets or, you know, educating yourself somehow, that would be the proper response. Not just, oh, don't do anything. Go to the gym, hang out with friends, booze up, you know, whatever. Just utterly ridiculous, guys. Now, by the way, let me just say this. These same guys who say don't worry about anything, don't worry about things, are the same people who back in 2008, when the markets crashed by 50%, they then said, oh, you know what? Now might be a time to pull out of the market and go into inverse ETFs. So when things become really bad, when things get really volatile and markets drop by 20, 30, 50%, then they say, oh, now it's okay to put money into inverse ETFs, markets that go in the opposite direction of the stock market. It's utterly ridiculous. Now, the thing I found worrying about a lot of the articles that are being written right now in the financial journals is not so much that, it's something else. It seems when I read that article and when I'm reading other major financial articles and videos, it seems a lot of people in Wall Street are actually giving the wrong suggestion, the wrong interpretation as to what a Fed cut decision means. In other words, guys, because the Federal Reserve has cut rates, it seems a lot of people in the financial media seem to think that this is a good thing for the economy. That's a good thing for the stock market. They're wrong. It's absolutely mistaken. So guys, whenever anyone tells you that when the Federal Reserve starts cutting rates after they've been raising rates, that it's a good thing for the economy, it's a good thing for the stock market, the only response should be this. Let me explain to you why. Because you see, guys, it's a fact, it's a historical fact, that whenever the Federal Reserve starts cutting rates after they've been raising it for a period of time, it's a dangerous sign for the economy. In fact, as John Hussman wrote in a recent article, he said that this is actually a precursor to a recession. He said that when they start easing, that usually precedes major recessions. And that's not all. This is also backed by the facts. Take a look at this chart. You will see from this chart that whenever the Federal Reserve has started cutting rates, when they started easing, that usually has preceded major recessions. As you'll see in the past, 2008, in the year 2000, before in the 80s and 90s, this has usually always preceded major recessions. So it's a dangerous sign for the markets, a dangerous sign for the economy. All right, guys. So that actually is what they should be saying. They should not be saying, oh, the Federal Reserve started cutting rates, so everything's going to be okay, don't worry. No, that's not right. They should be saying, look, here are the facts. Here's what usually has happened before when the Federal Reserve has started cutting rates. But it seems the target audience are not people like you and me. They're not targeting smart, intelligent individuals. They are presumably targeting the average person in the street, which even in that case, I think they should be doing the correct thing by educating people, by informing people. Anyway, guys, so thank you very much for watching this video. I hope this video helps. If it has, please give it a thumbs up, and I look forward to seeing you guys in the next video. Thanks a lot. Bye now.